Now we take up the era of the Accounting Principles Board, the second in the series of three private sector accounting standard setters. Remember, a committee, a senior technical committee indeed, of the American Institute of Certified Public Accountants, AICPA. It lasted for 14 years, from 1959 to 1973. The Accounting Principles Board's first important opinion occurred very soon, in 1962, and it involved accounting for the newly created investment credit created by Congress for the tax code when companies purchased depreciable assets, which Congress had just approved for inclusion in the U.S. tax code. The opinion was highly contentious, and it turned on the question of whether the investment credit should be reflected in companies' net income immediately or instead gradually over the useful lives of the depreciable assets thus purchased. Now, this has to be explained. The economy was in doldrums, and the Kennedy administration wanted to stimulate the economy by creating employment and encouraging more companies to purchase capital goods, long-lived depreciable assets. In order to do so, it persuaded Congress to pass a revision to the Revenue Act that established what is called the investment credit, which means if companies invest in certain qualifying assets, such as plant and equipment used for manufacturing, that a stipulated percent, let's say 10% of the purchase price, would become a credit against the company's tax, a direct credit. The question for accounting then is how you account for that credit. So if you purchase $1 million of qualifying assets, 10% of it, or $100,000, has to be dealt with in terms of accounting. Should it increase net income by $100,000, or should it be subtracted from the cost of the depreciable assets and therefore reflected in net income over the life or lives of those depreciable assets? It was a matter of timing, like so many controversies in accounting. The APB's opinion, which supported the gradual approach, that is, subtracting it from the cost and in effect depreciating it over the useful life of the assets, was overturned by the SEC, which declared that either method could be used, constituting an embarrassing setback to the nascent APB. Well, there were those on the Accounting Principles Board, including some of the partners of the Big 8 audit firms, who believed that it should be taken into income immediately, and there were others also from the Big 8 that believe it should be spread or shown gradually. They were called either the flow-through or the deferral approaches. And in the final vote, which was by the narrowest of majorities, 2/3 was required, just like with the Committee on Accounting Procedure, the vote was 14-6. That was the narrowest majority. Within the 14-6, there was a 4-4 division between the Big 8 firm representatives. All of the Big 8 firm representatives were always represented on the Accounting Principles Board with one vote each. 3 of the 4 who dissented, who favored taking it into income, made it known that they would not require their clients to follow the opinion. There was no requirement anywhere that companies had to follow the opinions. If the SEC insisted upon it, they had no choice, but nobody had heard from the SEC. Behind the scenes, the Commerce Department and the Treasury Department of the Kennedy administration were unhappy with the direction being taken by the Accounting Principles Board because it believed, apparently, that if companies could see themselves as more profitable, that is, taking the investment credit directly into income immediately, they would be more optimistic and more willing to invest in the kinds of capital goods that the Kennedy administration wanted to see occur. Not just a tax benefit, but an accounting benefit. And so representatives of the Kennedy administration made it known behind the scenes to the Securities and Exchange Commission that the Accounting Principles Board opinion, which allowed only the gradual approach, should not be sustained. And finally, in January of 1963, the SEC issued an accounting series release saying both of the methods, deferral and flow-through, in its opinion, had substantial authoritative support by companies, by audit firms, who were, after all, the experts, and therefore companies could use either method. And this constituted an embarrassing setback to the nascent APB. It was only the third year in which the SEC was dealing with the Accounting Principles Board, and its first major opinion was overturned by the SEC. Now, the press jumped at it. They began to discover that accounting is controversial. And Fortune magazine and the Wall Street Journal and the New York Times and a number of other publications, such as Forbes, began writing articles on what was going on at the Accounting Principles Board, because it was believed that there was a lot of interesting controversy that would capture the attention of readers of their newspapers and magazines. And so, beginning with the investment credit, the world discovered accounting. At least the world in the United States discovered accounting. And since that time, the financial press and even the general press, such as magazines like Time and Newsweek, began to get interested in accounting. Well, that was the first setback, and the APB had to live with it because, of course, the SEC had the authority to compel companies to use one method or another. The APB also foundered by failing to endorse a conceptual framework, which was yet another embarrassment. This also occurred in 1962. The board could not accept the research study done by two accounting academics at the University of California at Berkeley because it recommended the use of current values and discounted present values. Hence, it discarded the study and the project. Well, the major difference between the Accounting Principles Board, it was hoped, and the Committee on Accounting Procedure was that there could be a conceptual base for the Accounting Principles Board that would help it in devising what are recommended practices that could be justified on the basis of principle and not simply a vote of people who simply were expressing their views. Whereas with the Committee on Accounting Procedure, there was no accepted conceptual base. So the whole idea behind having a conceptual framework, that is to have research studies on accounting postulates and broad accounting principles, was to lay the theoretical groundwork for what were hoped to be sounder accounting principles. And since the APB discarded the study and the project, they were right back to where the Committee on Accounting Procedure was, meeting on each project without any conceptual guidance whatsoever. Now, why was this rejected? It was rejected because the two accounting academics, Munitz and Sprouse, who were asked to do the study, believed that they were to recommend what they thought was best practice on the basis of the literature, and not necessarily to indicate that accepted practice is sound practice. Well, one of the problems with the Accounting Principles Board, which I have not mentioned before, is when the AICPA composed its membership, it decided that only the national managing or administrative partners of the audit firms could be on it. The technical partners would not be on it. It would be national managing partners. Why was that? Because in the latter stages of the old Committee on Accounting Procedure, when the batons of membership were passed down to partners of somewhat lower standing that had been there before, that when the vote came up for an accounting research bulletin, some of the members were seen calling their home offices to find out how they should vote. Well, this was totally unacceptable to the leadership of the Institute, and they thought the best way to avoid this problem with the Accounting Principles Board would be to have the highest standing partners in each firm himself, and in this case it was himself, be a member of the Accounting Principles Board. The problem was that a number of the managing partners in charge of administration were not people who necessarily had a great deal of technical expertise or had the time to study technical issues. They, of course, knew accounting, but they were not keeping up with technical developments. They were not the people in charge of technical accounting within their firms. They were running the firms. Many of them were traveling frequently. They had a great deal to do, talking to clients, to government agencies, to policy organizations, to set strategic plans for their firms. And they didn't even have time frequently to do the homework before meetings. And they didn't really enjoy the meetings. There were a few who were very good at it, but most of them were not. They tended to be very senior partners in terms of experience and age, and very conservative, wedded to traditional accounting, historical cost accounting, so that when the authors of the accounting research study on broad accounting principles recommended a departure from historical cost accounting upward by recommending valuations of merchandise inventory, indeed at net realizable value, property, plant, and equipment at replacement cost, and long-term receivables and payables at discounted present value, none of which were accepted practice back in those days, the APB revulsed and said, we cannot accept this. This is not accepted practice. The SEC, of course, agreed with these views and said if any standards were to come out embodying these ideas, the SEC could not accept them. And so therefore, because the APB said we cannot make any use of this, it discarded the project, and the whole project had to die a borning. And this was also an embarrassment because this was to be the essential difference between the APB as an improvement on its predecessor, the Committee on Accounting Procedure. In 1965, the SEC clashed with the Accounting Principles Board over how to treat the deferred tax liability related to installment receivables. This seems like a fairly narrow issue, but it had very significant repercussions. Arthur Andersen, one of the big 8 audit firms, their AP member, it happened to be Leonard Spacek, argued that the liability should be classified as current when the installment receivable was current, and the APB in its exposure draft unanimously agreed. Now, what was the issue? Many of the major national retailers were selling on the installment plan, major appliances, such as refrigerators and dryers and washers and stoves, and they were sold to retail customers on long-term credit plans, payable in installments. They would therefore have in their balance sheet an installment receivable. They would recognize revenue at the time of sale, but for tax purposes, they would recognize taxable income at the time the installments were received, the installment basis of recognizing revenue. So therefore, there was a deferred tax problem, an income tax allocation problem, and there was a deferred tax liability because, of course, the incidence of taxation occurred possibly several years after the recognition of the very same net income. The question was where to classify the deferred tax liability when the installment receivable was current. Arthur Andersen was of the view that when the installment receivable was current, which means the installments were to be received within the current fiscal period, the related deferred tax liability should be shown among the current liabilities. Most companies weren't doing that. Most companies were showing the totality of the deferred tax liability among non-current liabilities because they did not want to reduce their working capital or their current ratio in dealing with creditors. And so consequently, the position of Arthur Andersen's was not acceptable to the firms, many of them. But initially, before the audit firm partners on the board could begin consulting with their partners, they liked the idea. They thought it made sense. It seemed symmetrical. And so the APB voted unanimously in an exposure draft in June of 1965 by saying that if the installment receivable is current, the deferred tax liability relating to it should be current. 3 months passed. The retail industry objected to a current classification for the liability under any circumstances, conveyed that message to the partners on the board. Many of their clients told them they don't like it at all, the retail merchants, and they pressed their audit firms to oppose it. 3 months later, in September 1965, the board reversed itself 14-2 and said, we are not going to give any advice on where to show the deferred tax liability. It can be shown wherever companies want it to be shown. And when the APB met to approve Opinion 6 later in 1965, that reversal was reflected in its final statement. Well, Arthur Andersen was furious. Arthur Andersen knew that the chief accountant, Andrew Barr, a very highly respected individual at the SEC and elsewhere, tended to agree with Arthur Andersen. So therefore, Andersen quietly petitioned the Securities and Exchange Commission to overrule the APB, knowing that the ACC chair, Manuel Cohn, had been strongly arguing for narrowing the areas of difference. And of course, the action of the SEC meant that with respect to the classification of the liability, companies could do anything they like. This was hardly narrowing the areas of difference. And so then the SEC called the leaders of the APB into its offices in Washington and berated them for not narrowing the areas of difference and for changing their mind as abruptly as they had. And shortly after that meeting, in the SEC's offices in November, on December 7th, an interesting date, the SEC issued Accounting Series Release number 102, in which it supported the position originally taken by the board, saying that where the installment receivables is current, the related deferred tax credit shall be current as a liability. And this shocked the Accounting Principles Board, realizing that if they don't begin narrowing the areas of difference, the SEC might begin setting standards itself. And this was a shock. A very interesting episode, again involving a conflict between the SEC and the Accounting Principles Board. During the 1960s, when many mergers were creating conglomerate enterprises, which in the past we had rarely seen, the SEC pressed the Accounting Principles Board to issue a standard on product line reporting, back in those days called line of business reporting, because once the merger had occurred and the conglomerate enterprise was created, it was no longer possible to find out how profitable various lines of business were. They were all merged into the final aggregate report of the company that had acquired the other company, the one that still was in existence. And there was a feeling that they couldn't make judgments about the efficacy of the merger and how well the company was doing unless there was a disclosure of product line profitability. But companies resisted disclosing product line profitability and conveyed that view to the APB, which was trying to issue an opinion, that's what they called their final bulletins, but could finally agree only on what they call a non-binding statement that encouraged, but didn't require, voluntary disclosures. That's about as soft as guidance can be, a non-binding statement that says you ought to consider doing it. This was a very mild recommendation, if it was a recommendation in any meaningful sense at all. Well, the SEC was frustrated. The Accounting Principles Board was not about to do anything. So the SEC instead turned to the Financial Executive Institute that represented industry to say, would you be able to give us some sound advice on which way to go? And the FEI commissioned a research study, got it done very quickly. And the research study then made recommendations which were adopted by the commission, which issued releases to require product line reporting in registration statements and in periodic reporting. And the Accounting Principles Board failed to act decisively in the face of industry opposition. So here, instead of looking to the APB, the SEC looked to a representative industry, which is not exactly what the accounting profession would have liked. Here was a case where the Accounting Principles Board did not perform the way it should have performed. Here is a very interesting case. It's a unique case involving the franchising of retail outlets, which was a growth industry in the 1960s. McDonald's, Burger King, Dairy Queen, they were all growing immensely during the 50s and especially the 60s, and they created an accounting problem. When the franchisor, such as McDonald's, signs an agreement with the franchisee, who will be the parties who operate the franchised outlet, signed an agreement. Typically, there was a very large down payment and a note that was given for future payments. And the question immediately became of when should the franchisors recognize the immediate down payment from the franchisee as revenue? Should they do so immediately, as almost all were doing, to increase their reported net income, or should they wait until they actually begin performing the many duties that they had to carry out in accordance with the agreement, giving advice on building the building, providing the agreements, training the employees of the individual putting out the sign, and providing all of the advice and services that franchisees needed in order to launch their enterprise. Well, virtually all the companies were engaged in what came to be called front-end loading of revenue, that is, recognizing the entirety of the initial deposit as revenue, even though they hadn't done anything to earn it yet. The SEC felt that was wrong, and they wanted to come up with a solution. They approached the Accounting Principles Board and said, would you take this up? The Accounting Principles Board was already very busy with a matter we're going to mention in just a few moments, dealing with pooling of interest and purchase in business combinations, and had no time on its agenda to deal with it. The SEC's chief accountant, Andrew Barr, did not want the SEC to be setting a standard. They wanted the answer to come out of the private sector. And so Barr got in touch with the chairman of the APB and said, could you identify someone who could write an article that would appear in the Institute's journal, the Journal of Accountancy, that would recommend sound accounting that we could cite as substantial authoritative support. This had never happened before, and it had never happened again. The chairman, who came from a medium-sized firm, identified one of his partners, a man by the name of Archibald McKay, who began drafting an article that reflected the views of most of the audit firms, who agreed that there shouldn't be front-end loading of the revenue. It shouldn't be recognized except in proportion to the rendering of the services by the franchisor for the franchisees, which were considerable and hadn't even begun. And once the draft was ready, it was passed around certain members of the Accounting Principles Board informally for their advice. They made changes and agreed to the final draft. It was then forwarded to the SEC, the Office of the Chief Accountant, which reviewed it and said it's fine, and it was published almost immediately. And as soon as it was published in the Journal of Accountancy in January of 1970, the SEC announced that it regarded the article as constituting substantial authoritative support, and therefore all franchisors had to begin recognizing revenue in accordance with the process of rendering the services and providing the supplies under the franchising agreement. This was a unique case by which a journal article becomes substantial authoritative support, all orchestrated, of course, by the SEC chief accountant. During the APB's 14 years, while there were some successes, the SEC chief accountant almost constantly intervened in the board's standard-setting process and thus severely limited its ability, that is, the APB's ability to work its own will. This was acknowledged by the board very early on, when there would be a discussion of a novel practice, and there would be those in favor of one approach or those in favor of another. Typically, somebody at the board would say, let's find out what Andy has to say before we go any further. Andy was Andrew Barr. There was a recognition that nothing could get through the Accounting Principles Board unless the SEC chief accountant was first consulted as to whether he would agree. It was almost as if he had a veto. In effect, he did have a veto, a private veto over the APB, in part because Barr and the other people at the SEC did not have confidence that the board was willing to narrow the areas of difference, and it felt that as a part-time board, it was too much under the thumb of its influential clients. This was a concern with a part-time board. One frustrated APB member characterized the SEC-APB relationship as one of top management and middle management, where the APB does the bidding of the SEC and gets all the heat from industry for the standards that it does not like. And when the APB, under SEC pressure, tried to narrow the areas of difference, there were attempts. Industry engaged in intense lobbying of the board to oppose the elimination of accounting methods which it preferred. And this made the life of the Accounting Principles Board very difficult. If it tried to narrow the areas of difference, it received the approbation of the SEC. But at the same time, it received the opposition of industry, which did not want to be told it could not use certain accounting methods which it favored. Now we come to the biggest issue of the decade, even bigger than the investment credit was, and again excited interest in the press all across the country. In 1968-1970, the APB tried to get rid of pooling interest accounting for business combinations, which the CAP had approved in 1950. Pooling of interest accounting allowed business combinations when the acquirer used its capital stock to finance the acquisition to be accounted for at book values, not fair values, of the acquiree's net assets. This emerged to the approbation of merger-minded companies in the late 1940s and early 1950s. When you purchase a company, it's like any purchase that you make. You show it at the cost you incurred, the fair market value of the shares of stock given if you purchase an asset by giving shares of your own stock. But suppose you purchase the whole company and you don't just purchase some of the assets of the company. How should that be recorded? Well, often when you purchase a company, you would like to take over its earnings per share and add its earnings per share to the acquirer's earnings per share. But if you acquire the company and the fair value of its tangible assets has increased considerably over the historical costs that are shown on the books of the company being acquired, this means that depreciation expense and amortization expense, and for inventory, cost of goods sold, will be a lot higher once you engineer the merger for the merged company than they would be on the books of the company that you're thinking of acquiring, which would reduce the earnings per share that you would take over almost to the vanishing point in some cases, because the depreciation expense and the amortization expense, and in the early years, the cost of goods sold, all based on the upward revalued figures reflecting the fair values that you would be recording, would reduce the earnings per share attributable to the company being taken over to a very low figure. Companies did not like that outcome. They said, look, if the company taking over the other company is about the same size as the other company, and you keep the company management, and by issuing shares of our stock to the former shareholders of the other company, they have a piece of the merged enterprise. And furthermore, you might even be in the same line of business as them. It's kind of like taking two tributaries that come together to form a river. You can't really say which was the major one and which was the minor one. And therefore, it is not really a purchase in the normal sense. It is a kind of fusion or a coming together of two entities, not justifying a recognition of new valuations. And in this way, using something like they called pooling of interest, you could take over the assets of the other company and assume its liabilities at whatever amounts they are shown on the books that is being acquired, and not recognize higher or indeed lower valuations. Companies loved it. You could take over the entire earnings per share. Therefore, this was set up in 1950 under an accounting research bulletin. It had been reviewed a few times, and as time passed, the various criteria that identified the kinds of mergers and acquisitions that would qualify for pooling of interest were eroded as more and more companies that were not just about the equal size, but maybe twice or 3 times or 4 times or 5 times or 6 times the size of the company being taken over could still qualify for pooling of interest accounting. The SEC was buffeted with these questions. Would this proposed merger qualify for pooling of interest accounting? A substantial fraction of the time of the office of the chief accountant was spent responding to companies inquiring about whether a particular merger or acquisition with the use of capital stock would qualify for pooling treatment. Everybody wanted pooling treatment. Nobody had wanted to be accountable for higher valuations. And since the property, plant, and equipment of many companies being taken over had been purchased years, if not decades ago, there was a considerable difference between their historical cost and their current fair values. Well, finally, by the end of the 1960s, there were so many parties inside and outside of government who wanted to get rid of pooling of interest accounting. It was laid at the doorstep of the Accounting Principles Board. Their first position in an exposure draft was to prohibit pooling of interest accounting. There was such a negative reaction from industry that they got rid of that idea altogether. And then they said, well, maybe we could continue it as long as the participating companies met a whole host of factors. And of course, one of the questions is, what would be the size test? What could be the relative sizes of the 2 enterprises that would justify pooling of interest accounting? As I say, industry brought intense and persistent pressure on the APB not to eliminate poolings, even blanketing the country's press with its insistent anti-APB campaign. They issued press releases. They approached the SEC and said, what was your position? The SEC was in effect saying, we are going to support the Accounting Principles Board. But if the Accounting Principles Board doesn't act, we will decide what the position is. So there was requirement that the APB had to act. After attempting numerous failed compromises, a divided Accounting Principles Board finally allowed pooling of interest accounting so long as the business combination were to satisfy a dozen specific requirements. The APB also required that goodwill be amortized over not more than 40 years, the first time any standard-setting board had said that goodwill has a specific life. Why 40 years? That means that the amount of amortization expense would be no more than 2.5%, thus reducing net income by a very low amount. So the larger the number of years, the lower the expense that will appear on the income statement. And 40 years was the choice adopted, and that meant 2.5% maximum per year. Again, a highly divisive compromise position. This was an embarrassing episode in the APB's tenure. Many of the partners of the firms and many parties interested in the effectiveness of the APB felt the APB could not handle itself when the matter that came up was as divisive and controversial that generated as much aggressive opposition from industry. Finally, in 1970, there was a series of 3 letters written by senior partners of 3 of the Big 8 audit firms to the president of the American Institute of Certified Public Accountants, saying, in the light of the debacle concerning the continuation of pooling of interest and the APB's inability to deal with a hot issue like that, we have lost confidence in the Accounting Principles Board. We don't feel we can work any longer. We are not sure we will continue to send members to the Accounting Principles Board. And this was set off an alarm at the Accounting Principles Board that the 1971, following complaints from 3 major audit firms of the APB's inability to issue standards that improve financial reporting, the AICPA again created the study group to propose a better way of setting standards. It actually also set up a body to recommend objectives of financial reporting, which were in doubt all of the 1960s. Now, this was an important point. When deciding on who would be the chair of the new study group, the American Institute of CPAs wisely looked to the SEC, a commissioner who was highly respected, a former commissioner who had been highly respected as a progressive thinker at the SEC, a man by the name of Francis M. Wheat, who was a lawyer from Southern California. It was believed, and I think rightly, that if the study group looking into a new way of setting accounting standards was chaired by a former and highly respected SEC commissioner, the SEC would be very likely to accept its recommendation and support the new standard setter in a way that it really didn't support the Accounting Principles Board. So, as I say, importantly, the study group was chaired by a former SEC commissioner in the hope that the SEC would support the standard setter it would recommend to the Accounting Principles Board. The study finally recommended the creation of a full-time 7-member Financial Accounting Standards Board, the FASB, to be formed under an independent financial accounting foundation whose trustees would raise funds, select the FASB's members, and oversee its due process. Well, this was a debate within the body. This was the first full-time accounting standard setter anywhere in the world. And within the study group, there was considerable controversy over whether this was a sound approach. Quite a number of them didn't like the idea of taking this out from under the accounting profession. It would no longer be a committee of the AICPA. Would the AICPA even be willing to go along with this idea once the study group, which had been appointed by the AICPA, were to make its recommendation? There were philosophical differences. How would this body work? What would be the majority? How would you choose the members? What would be the composition of the Board of Trustees? Where would the funding come from? Because it wouldn't come solely from the AICPA and from the audit firms. The Independent Financial Accounting Foundation would have to raise funds from corporations and audit firms and any other sources. So it was very controversial. But finally, the FAF was created after the study group, which was unanimously approved by the members, was finally approved by the Board of Directors and Council of the AICPA, not without dissent. There was debate as to whether this was a sound way to go. The AICPA approved the study group's recommendation, and the FASB, the first full-time accounting standard setter anywhere in the world, succeeded the Accounting Principles Board on July 1st, 1973. Now, a note at the bottom. The AICPA nonetheless retained considerable influence over the FAF, the foundation, and thus over the selection of FASB members. Naturally, the AICPA was not happy at losing its control over the standard setter. Of course, the first two standard setters were committees of the AICPA. So as a kind of compromise worked out between the study group and the AICPA, of the 9 members of the foundation, the 9 trustees, 5 would be partners in audit firms. All of them, as it turned out, were active in the leadership of the AICPA. 5 of 9 is a majority. The FASB was chosen by the trustees. 4 of the 7 members of the FASB, according to the study group's recommendation, had to be partners in audit firms with public practice experience. 4 of the 7, a majority. So in these ways, the AICPA and the accounting profession generally continued to have considerable sway over the FAF and the FASB, even though the FASB was a separate body, but not entirely independent of the accounting profession. That was a concern, and we'll talk about that a bit later on. For the first time ever, in 1973, the SEC publicly announced its support of the new standard setter. Never done that before. In October of 1974, after the accounting principles of the FASB had been launched, the SEC issued an accounting series release saying that it continues to look to the private sector for leadership in setting accounting standards, and specifically it looks to the Financial Accounting Standards Board. Now in 1972, remember I said much earlier, the last of the four original chief accountants, in this case Andrew Barr, finally retired. The ones who joined the commission in the 30s and had this sense of mission about upward valuations of tangible assets not being recognized in financial statements. 1972, the last of the four chief accountants who had joined the SEC staff in the 1930s retired, all of whom had strong views on what constituted sound accounting principles and practice, and who frequently intervened in the work of the Standard Setter. And the successor was Sandy Burton, John C. Sandy Burton, and he was the chief accountant for 4 years, 1972 to 1976. And he had been a professor at Columbia University, the first chief accountant who came from academia. And he continued to oversee the board's work with a critical eye. Now, one further thing about Sandy Burton. Shortly after becoming chief accountant in June of 1972, he made it known to the Accounting Principles Board he would like to see a standard come out that required the lessees of long-term non-cancelable lease agreements of property, plant, and equipment to recognize in footnotes the present value of their future payments under the lease agreements. There had been a raging controversy for years about something like $3 trillion of leased property, plant, and equipment where the lessees did not show on their balance sheet an asset or a liability for this leased property, grossly understating their assets and liabilities. It was called off-balance sheet financing, a term that nettled the Accounting Principles Board and the accounting profession. But industry loved it. It was a way of avoiding having to show all of the asset and the debt, and to reduce companies' debt-to-equity ratio by not showing the long-term liability at its present value in the financial statements of the lessee, the party using the property. Sandy Burton didn't like this any more than anybody else, and he thought a temporary or provisional solution would be to require the lessees to report in their footnotes the present value of their future payments under the lease agreement as if they had actually capitalized it. That would be the amount debited to the asset and credited to the liability if they had actually shown the two in the body of the statement. Well, the Accounting Principles Board rather naively developed an exposure draft calling for that, and as soon as that draft went out, industry, particularly the lessees and the leasing industry, reviled against it, argued against it, said it doesn't work, it won't work, and it's unsound, and it will cause an awful lot of companies who would like to acquire property, plant, and equipment, but cannot issue long-term bonds in order to finance it, not to invest in these properties, and therefore will inhibit the growth of industry and will be bad for the economy. All sorts of arguments were raised, which were heard by the Accounting Principles Board. And finally, the board said, we can't recommend recognizing or showing the present value. We will show only the aggregate of the payments in the future, not the present value. Sandy Burton was insistent, and he said, if you don't do it, I may do it through the SEC. Finally, in the last of the opinions issued by the Accounting Principles Board, in its last month of operation, June of 1973, it issued Opinion 31, which required lessees of long-term, non-cancelable lease agreements of property, plant, and equipment to show in footnotes only the aggregate amount of future payments, not also the present value. Several months later, in October of 1973, the SEC, at the behest of its chief accountant, issued an accounting series release which said that henceforth all of these lessees must also show in their footnotes the present value of their future payments under the lease agreements. And this remained as an SEC requirement until 1982, when it was finally rescinded under the Reagan regime of reducing the amount of regulatory overload. So from 1974 to 1982, this was a requirement. And again, it brought the SEC into conflict with the Accounting Principles Board, this time with the new chief accountant. Now, there's one other matter I'd like to bring up, and a very important matter that's not reflected on the slides, and that is the coming back of the investment credit. We talked about the investment credit in 1962 and 1963, and how the SEC had overturned the Accounting Principles Board's opinion, saying that the investment credit had to be taken into income over the life of the depreciable properties purchased. The matter came up again in 1971. Richard Nixon was president. The economy was again in doldrums. They thought that since the investment credit had worked not only once in 61, 62, it had worked again in 1967, they said, let's try it again. This was the administration of President Nixon. So the administration, specifically the Treasury, asked Congress to reinstate the investment credit, which had been turned off when it didn't have to be used anymore. And the question again arose as soon as this message was sent to the Senate and the House began working on bills to reinstate the investment credit. How should accountants treat the investment credit? The APB still held to the view by a slight majority that the effect ought to be gradual, not to be taken into income immediately. And it realized that back in 1961-62, it wasn't only the SEC, but it was forces within the administration, such as Treasury and Commerce, that were excited and upset about the board's position. So it first went to the Treasury, talked to a Treasury official, argued in favor of the gradual approach. The Treasury official seemed to agree, sent a communication to the APB saying, we will not object to your suggestion that this be taken into income over the life of the depreciable assets. The Accounting Principles Board then took the letter to the SEC and said, the Treasury has agreed to stay out of it this time. Will you agree to support us? The SEC said, yes, we will agree to support you. So therefore, with an understandable amount of trepidation, the Accounting Principles Board in late 1973 began developing an exposure draft calling for the mandatory deferral of the accounting recognition of any investment credit, while Congress was developing legislation instituting the investment credit. But very shortly, the view expressed by the member of the Treasury Department at a relatively low level percolated up to the top. John Connally of Texas was then the Secretary of the Treasury. He'd been overseas, and when he came back was informed of this view expressed by one of his subordinates. He said, this is not the position of the Treasury. Our position is that companies should be allowed to use any method of accounting for the investment credit that they like. And he said, if it's necessary to modify the legislation accordingly, we will do so. The SEC made it known they were supporting the Accounting Principles Board. So one bright day in November of 1971, a member of the Senate Finance Committee stood in the well of the Senate and introduced an amendment to the bill going through the Senate, saying that once the investment credit is instituted, taxpayers, as corporations, reporting to the Securities and Exchange Commission, can use any method of accounting for the investment credit that they like. Well, as soon as the APB saw it, it was apoplectic, and it began descending on Capitol Hill, hoping to lobby that out of the bill. Industry was deliriously happy, and they were lobbying to keep it in the bill because they had made their views amply known to the Treasury. And in December, when the bill emerged from Congress and signed by the president, it included the amendment and therefore, of course, prohibited the SEC and the APB from doing anything. Congress had spoken. Congress had set an accounting standard for the first time ever. And this remained in legislation until 1986, when Congress finally got rid of the investment credit in the Tax Reform Act of 1986. And so this was the last of the very controversial episodes, in this case, the SEC supporting the Accounting Principles Board. And who opposed them? Well, it was Congress. And why was it Congress? Not just the Treasury. It was also industry acting through Congress, getting to the Accounting Principles Board.